Do you think that the Fed is more impactful in the markets today than they were in the past? And if so, why do you think that is?
Oh, definitely. Well, I think one, they're more impactful because they use forward guidance as such a significant policy tool. So that is actually something relatively new. Just the idea of having a press conference after hiking interest rates is a relatively new phenomenon that didn't happen before at the Ben Bernanke Fed. So extremely impactful. The other thing is, if you look at the size of global central bank balance sheets today, in total between the People's Bank of China, the European Central Bank, the Fed, and the Bank of Japan, we're right at around $20 trillion in assets. So that's the size of the U.S. economy. So it's not just the Fed is an important thing, it's almost they're the only thing, because their balance sheet is so huge and they can dictate just through their language what goes on in every asset class across the globe.
So is it fair to say that the last 10 years have really been primarily driven by central bank easing?
Yeah, I'd say so. We obviously create a lot of charts, especially around the Fed, but we kind of say if there was one chart that you could look at since 2008 to determine how you should manage your portfolio, it's just the accumulation of global central bank assets. And when they're going out and buying corporate bonds, buying treasury bonds, in some cases even buying stocks and ETFs like the Bank of Japan is doing, you should be buying risk assets. And when the pace of their buying slows, you should be getting defensive.
Or reverses.
Exactly, or reverses, which is what's happening now.